So a buyback finally, and you gave us some guidance on that earlier in the year, but no dividend. What's the thinking, and what does it take to get a dividend from you?
Well, we were clear earlier this year that we were only intending to pay one interim dividend at the middle of the year, which we've done. We paid 7 cents. We will and do intend to pay a dividend for the final full year results. In between time, we looked at our capital base. Our core tier 1 ratio is 15.9%. We want to get back to being in our target range of 14 to 14.5 over the next year or so. And so today's $2 billion buyback is an important step, I think, and it shows confidence that we have in the underlying performance of the business and outlook, and shows a commitment to try and normalise our capital base.
Now, the top line beat of $6 billion in part driven by the credit loss releases. Is this the top of credit loss releases?
Yeah, well, we've released about 70% now of the reserve build-up that we had in credit losses last year that we built up in the context of the onset of COVID. We still retain about $1.2 billion of reserve build-up. I think it will be much slower now, what we'll see coming out in the next 2 to 3 quarters.
You've also released information. You've got $19.6 billion exposure to property. Noel already made it clear that you're not too worried about direct links to real estate. What I want to know is what level of this $19.6 billion is red or orange or at danger if things get worse in the property market.
Well, none of that $19.6 billion is direct lending exposure to any Chinese property developer who is in the red category. So we're reasonably confident and comfortable with the credit exposure we've got to the Chinese real estate market at the moment. We've obviously just been through an exercise as a result of these results of looking at credit provisions in China. We are comfortable. We've managed to write back a significant amount of ECL reserves this quarter, and I think you should read into the buyback the fact that we are confident about where we're sitting at the moment in our risk positions.
Give me your perspective. Noel talked about the second and the third round impact on capital markets and bond markets. Ewen, given the ongoing Evergrande saga, do you think we're only beginning to see the impact on markets, or are we nearer the end?
Look, I think the Evergrande situation has been well telegraphed to the market for months now, so people have been able to adjust, take views. So I'm not saying never, but our view is that we're not going to see any material fallout as a result of this.
Do you think the Hong Kong market, Hong Kong is a critical market for you. Is the Hong Kong property market insulated? Do you get a sense from what's happening with Evergrande?
Well, Hong Kong, as you say, it's a third of the group's profits. It's our most important market. I think that the Hong Kong real estate market has proved to be resilient through many, many cycles. There is effectively a shortage of good quality property in Hong Kong, and our exposure to the Hong Kong property market is significant, but our coverage ratios are high, and we don't see any particular spillover impact at the moment into Hong Kong.
A few friends that left Hong Kong a few years ago, be happy to hear that guidance from you in terms of the scarcity value. Look, we've had lots of names talk about risk aversion to China. I don't need to give you a laundry list. Do you think global investors' risk appetite for Chinese assets is weakened, materially weakened?
Well, all we can see is through the lens of our own business. Our revenues in China were up 20% year on year. Our profits were up more than 30%. We're continuing to invest heavily. We started up a new life insurance venture this year called Pinnacle. We're already up to close to 500 advisors into that business. So for us, we continue to be very bullish about the long-term growth opportunity in China.
What about the investment bank, Ewen? What was the performance like there? We got barnstorming numbers from the Americas, from Goldman's and Morgan Stanley. How did your investment bank do?
It did okay. I think it's important to note that we've got a different business mix to a number of the US peers. We're a lot smaller in the US, we're smaller in equities, we're smaller in advisory. Overall, revenues for global banking and markets were down 3%. Within that, we had some good performances in some of the product lines like equities, security services and capital markets and advisory. And we managed to do that even though we ran risk-weighted assets down 7% over the year. So it wasn't a barnstorming performance, as you saw out of some of the US investment banks, but I think on a like-for-like basis, we're comfortable that it was a good performance this quarter.
Jane Fraser at Citi says, I want to crush the competition. Are you losing market share in America? She wants to crush the competition. And Brian Moynihan says there's a war out there and he's winning it.
Well, we want to compete in the US for the companies that we think are consistent with our business model. Those companies that want to trade internationally. We're the biggest trade bank in the world. We've got undoubted strength in Asia that crushes, I think, any of our US competitors.
And the crushing blow is the important point when it comes to closing the deal. What can you tell me from the customer side in terms of these supply chain bottlenecks, Ewen? Where is it geographically most manifest when you talk to the customers?
Look, we can definitely see supply chain impacts impacting our customers. It's also denting confidence. If there was any slight disappointment in the numbers this quarter, it was we had expected commercial loan growth to be stronger than what it was. And we are seeing customers having to build up and maintain high levels of working capital at the moment as a result of the supply chain issues. So it is definitely having an impact. We do think it'll be relatively temporary. And that should imply by the time we get back into 22, we should see much more sustainable, solid growth.
Do you think the inflation tops out mid-2022, as Yellen said overnight?
Look, we're not believers in stagflation at the moment. A little bit of inflation is very, very good for us. It brings the prospect of earlier rate rises. We're a very interest rate sensitive stock, so we would welcome a bit of inflation and better interest rates.
You're a gift to me, Ewen. Let's talk about the British bank, because Bank of America say that that's where you've got the most sensitivity to rates. So let's deal with the UK. Bank of England looks as if it's live in November. The market's pricing in 1.2% by the end of next year. Can you see that magnitude and speed of hikes in the UK, Ewen?
Certainly. I remember we're currently at about 300-year lows in UK policy rates. I think the economy can afford higher rates, but certainly you could see 2 or 3 rate rises between now and the end of next year.
Do you think we could get to 1% by the end of next year, Ewen?
Yeah, I think that's possible.
What would that do to your business?
It would add, I think, on a forward run rate basis, several $100 million of additional net interest income, in addition to the growing book and volume growth that we're putting on in the UK. So it would be welcomed by us overall for the bank. 100 basis point parallel shift in interest rate curves adds about $7 billion of revenue to us.
Look, the flip side of that is, as I'm using Danny Blanchflower, but you can pick anybody you want, is that it would be a serious error to hike into rising national insurance, COVID risk, furlough coming off, a myriad of other tax rises. Would you see it as a potential policy error or a policy mistake to hike rates in the UK?
Look, there's clearly a path to navigate through that for the policymakers, but I think interest rates rising to 75 basis points or 100 basis points is not going to be the dominant driver of the preventing a recovery here in the UK. What
would be the biggest prevention to a recovery, Ewen?
Yeah, look, we continue to be concerned about tail risks and new variants emerging out of COVID. We continue to see around the globe a very stuttered recovery in some places as a result of the impact of the Delta variant. I think in the UK here, we're through the worst of that. But if we were to see new variants emerge, we could have a material impact on the business.
Ewen, as you look at 2022, we're trying to understand the narrative for 2022. We're now moving into more rate hikes this year than we had rate cuts last year. What is the biggest risk going into 2022? Is it a rate shock or something else?
Look, for us, I mean, I think, out of today's results, you see a much more confident tone from us about 2022. We do think we'll be back into a period of more sustained volume growth. Interest rate rises will be a further kicker on that. We are seeing some inflationary pressure coming through on our wage bill. Our total compensation costs are about $19 billion out of the $32 billion cost base. But overall, I think, what would we be concerned about is some kind of significant dislocation to the markets, denting recovery and confidence.
And that could be any great squall. You talk about income. Let's just close off with this. Jamie Dimon called in from having tea with the Queen. Unfortunately, you're only having an interview with me to tell his wealth managers that they were going to get a review in their pay structure. Ewen, I know it's Bloomberg and it's not Windsor Castle, but can you afford not to review your wealth managers' pay structure and comp in the eye of Jamie Dimon?
We are seeing inflationary pressure in our wage bill globally, not just in wealth management, but in a number of sectors and a number of geographies. We want to pay competitively, and we have increased the size of our variable pay pool this year, consistent with that. So, I think we recognise there is a war for talent in many places, including the wealth management sector.